Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Enlightened investors, happy to be back with you again today. I'm your host, Dr. Alan. If this is your first time tuning in, I give you a special and warm welcome. If you're a busy professional with little time to worry about investing, you've come to the right place. Our company, Steve Talker Capital, is an investment company designed for busy professionals like you to help you develop financial freedom built on solid passive real estate investments. We've created an Enlightened Investor Circle just for you. So go to our website today and enroll in the Enlightened Investor Circle. There you'll receive concise but thorough education and support that will save you time in your passive real estate investing journey to financial freedom, no matter your level of investment experience. For our initial launch of Real Estate Investing Abundance, we continue to bring back our superstars from our Creekside Chats podcast. With us today is Charles Seaman, who is the lead acquisition manager for Three Oaks Management, where he locates and underwrites high-performing multifamily real estate deals throughout the Southeast United States. He is also involved in contract negotiations, capital raising, and asset management. With close to 20 years of real estate investing experience, Charles brings a wealth of knowledge and expertise. Today, Charles will speak to us about the process of relationship building in real estate investing. We will also delve into all the important topics of underwriting, learn what it is, and how to use underwriting analysis to determine the viability of any real estate investment. So without further ado, let's get into this engaging and enlightening conversation. Welcome to the show, Charles. So let's begin with your story of relationship building.
Absolutely. Thank you very much for having me, Dr. Allen. So what we're in here is the people business, and that's true of many businesses, but probably very few more so than real estate. And in any aspect we're looking at, whether it's on the acquisition side or the investor relations side or the deal sponsor side, we're always going to be dealing with people and building relationships. And there's a lot of things that go into relationship building, but for what we're doing here in real estate and specifically for syndication, there's a few different people that we want to focus on. So for me personally, for my team, I'm in charge of acquisitions. That means I find deals. I'm in charge of sourcing deals, and I do that by engaging brokers. So when you're first starting out, whether it's the investor relations side or the acquisition side, you're not going to have a lot of credibility. And it's going to take time and effort and hard work to build those up, and also consistency. So oftentimes what I tell people, and I know what I find most effective, is that I'm very old-fashioned in my approach, and the more that I can engage in-person, face-to-face contact, the more that I find that I excel with it. So nowadays, we're fortunate that we can do things virtually. We can do things on Zoom. We can do things through other virtual platforms where that may not be as important. But for me, I find that I have a lot of success in person because it gives you a more personal connection than you would ever get virtually. And what I recommend and I tell people to do is, first off, after you pick your target market, once you do that, you want to find brokers that you can engage with and start building relationships with. And initially, those will probably start with phone calls and emails and maybe looking at a few deals. But the sooner you can get in front of them, the sooner that you'll find that you'll realize more success and speed up the growth of that relationship. I would also say the same thing would apply on the investor relations side. So for anybody out there looking to find money and find investors, I would find that you could also have similar success. And oftentimes, if you're able to utilize some type of combination of both virtual and in person, you'll probably speed up your results and accelerate the growth of your business that much more. Dr. Allen, did you have any specific questions that you wanted me to talk about, or just go into a little more of how relationship building could benefit the listener?
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145 or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. Give us a concrete example of how you started developing relationships, because you started from scratch, which a lot of people have to. You didn't have parents in the industry. You didn't have close friends in the industry. And so you built your relationship aspect from ground up. Give us some concrete examples of how you developed that over the years.
Absolutely. So one thing I always recommend for people, if you're looking for brokers, what I would recommend is going to LoopNet. Now, I would not recommend using LoopNet to find deals. I would recommend using it to find brokers, so take note of that. So my approach is that I usually look for the brokers that are selling the types of deals I'm looking for, and then I'll reach out to them on LoopNet. And what I'll do is the ones that respond, I engage them, and I typically respond back and tell them, I really have no interest in the deal that I contacted you about. If it's on LoopNet, there's a good chance it has no potential, but I'm interested in building a relationship with you because you probably have other deals that may make more sense. And then from that point, my goal is to get on an introductory phone call. And from that point, eventually to take the next step and meet them in person. So if it's something where you're across the country, obviously that may take a little more time. Initially, when I started doing this, I was in New York and I was looking in other markets. And then eventually I picked up and just moved to the other markets. So that way it made it a lot easier and a lot more affordable to do so on a regular basis. And you can use LoopNet to find brokers that are selling the types of deals you're looking for and then start to engage with them. One thing that's recommended with any relationship, now whether it's a broker, an investor, or anybody else, is establishing commonality. While it's good to discuss business, it's better to discuss things that aren't business related because you build a stronger personal bond. And once you have a more personal connection, it makes them much more willing to do business with you as long as they have faith in your ability to actually perform. So another question you might be asking is, how do you give them confidence in your ability to perform when you're brand new? And that's a great question. So the thing is, as Dr. Allen already alluded to, nobody has credibility going in because you're starting from ground zero. So the brokers know that there's a lot of people vying for their attention, but they only have so much time in the day. So the time is going to be spent on the people they believe have the highest likelihood of actually closing a deal and ultimately making the money. So initially, it's going to take time, and you're going to gain their trust by being consistent. Oftentimes for me, really more than anything else, it was consistency. I understand the lingo. I know how to speak to brokers, and that's something that I've been around for a long time, so I have that skill set. But even with that, talking a good game goes a long way, but actually performing and being consistent goes further. And what does that mean? So it means different things to different people, but in terms of broker relationships and just giving them confidence, it's looking at a deal that they send you and it's getting back to them with feedback. So one mistake a lot of people make is they look at a deal and they say, oh, this deal has no potential, and they don't even respond to the broker. So the broker thinks, okay, this guy's not a serious buyer. He's not looking at the deal. And I always tell people, and this will tie into underwriting as well, when you underwrite a deal, the single most important thing you can do, regardless of whether the deal makes sense or not, is to reply to the broker with feedback. And feedback comes in many different forms. For me, it's usually in the form of questions. I'll usually let them know I looked at the deal by questioning anything that comes to my attention. And then I'll usually give them some feedback and say, okay, I'm interested in this deal. I'll submit an offer. Or I think we're too far off. We're probably not going to be competitive, so I'm not going to waste your time on it. And by doing that consistently, again, what'll happen is you'll start to build some rapport with them. You'll start to build some trust, and they'll start to say, okay, this guy's a real buyer. He looks at deals. He engages me. He gives me feedback. And what also happens is as you start submitting enough offers, even if you're not getting them, brokers track who submits offers on their deals. And as they're tracking it, what they do is they may consider you for off-market deals in the future. So all of a sudden, if you submitted offers on 10 different deals and you didn't win them, but let's say you were close, you were somewhere in the running, they may eventually say, okay, we have an off-market deal. It might be good for this guy. Let's give him a shot and see if he's able to perform. And little by little, you chip away at it. It's like peeling an onion, one layer at a time. So you just take it one step and you advance a little bit each day. And that's something I think also is beneficial. So some people have the mentality where they're looking to go from 0 to 180 very quickly. And that's a great mindset, but not always practical. Oftentimes it leads to discouragement and it leads to things that we may feel inadequate. Why aren't things moving as fast as I want them to? And the reason is because we're looking at multi-million-dollar real estate deals. If they were simple, everybody be doing them. So it takes time, it takes effort, it takes a lot of relationship building and a lot of trust building. So that's going to take a lot of effort and a lot of consistency. But eventually, if you do that, people will gain enough trust in you where they feel confident awarding you a deal or investing in your deals. And then you'll have those relationships as long as you continue to cherish them and to value them.
Thank you for that example, Charles. I like how you suggest starting with LoopNet, not necessarily to find deals, but to actually find brokers. And once you find the brokers, then you engage with them on a particular deal, but you're right up front about the fact that you're not interested in this particular deal, but what you are really interested in is actually developing a relationship with them, and you're very upfront about the fact that what you're here for is to develop a relationship. From that, you move on from that, and the deals that they do present to you, you interact with them on each and every deal they send, and whether you're interested in it or not, you don't just ignore it, you get back to them and actually give them feedback and let them know where you are and where you stand. And eventually they do give you deals that you're interested in, and at least you're close on those, and you do present the offers on those, whether or not you have a chance of getting them. Through that whole process, you're actually developing a rapport with that, and they eventually get to the point where they trust you enough to actually bring you off-market deals, which is probably where you're finding a good number of the properties that you're investing in, particularly in this very competitive market. Most of what is out there and on market are going to institutional buyers who are willing to pay a higher price for lower returns than what most private investors are willing to look at. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Let's move on here to this aspect of underwriting. That is a large aspect of what you do, and I suspect it consumes a good portion of your time, effort, and energy. So explain to us exactly what underwriting is. It's a term that is tossed around oftentimes, and I'm not sure it always has the same meaning for everybody, but what does underwriting mean to you?
It is definitely not the sexiest role to be in, but it is a very important one. And underwriting is the financial analysis of a deal. So what we're doing is we're taking the existing financial performance, and we usually get that from the trailing 12 or T12. And what we're doing is we have an underwriting tool that we use. So for us, we use the syndicated deal analyzer, a pretty popular one. And you have some type of tool, most times a spreadsheet, where you're going to be entering the existing data, and then you're also projecting forward with how you plan to operate the property. So keep in mind, we're going to be using the seller's numbers as a starting point, but if we're not going to operate the property the same way that the seller is, then it won't be 100% accurate for us. So we use that as a starting point, and then we adjust it forward with how we plan to operate the property. And that ultimately tells us either this deal works or this deal doesn't, because we have certain metrics that we look for, as most syndicators do. And with the underwriting, it's going to say, okay, we hit these key metrics, or no, we fall short of it, and this deal's not going to work. Or at least it's not going to work at this price.
So the T12, for those who may not know exactly what that is, that's actually the 12 months of income and expense. And the ultimate aspect of that is, of course, the net income and what is the profit on that. So that's what T12 is. So tell us, in terms of analyzing these, what are the important numbers that you are looking for when doing the underwriting for any prospective deal?
Sure. So there's really four numbers that I like to hone in on personally. So to me, the most important is debt coverage ratio. And the reason I'm going to say that is because that will not make or break a deal. No investor will ever invest in a deal based on debt coverage ratio. But what it will do is allow us to sleep well at night knowing that the deal is safe and that we have enough cash flow to support the mortgage. Then the other three metrics that I focus on, and these are the ones that most investors are more interested in: cash on cash return, average annual return, and IRR. So those are the three that many investors look at. So cash on cash return really indicates the cash flow that we'll be receiving in exchange for the amount invested. So that's something that's very important to a lot of investors, especially for investors who are looking for monthly or quarterly distributions because they're using that to support their lifestyle. So if you have somebody that's living off that or using it to supplement their income on a regularly scheduled basis, that's going to be very important to them. Average annual returns, a compilation of both the cash flow and the proceeds from the sale or refinance. So that's going to be a bigger picture outlook. And depending on the investor you have, sometimes it may be more or less important than cash on cash return. So if you're somebody who's younger and in the prime of their working years, earning a lot of income, and you're not looking to live off this, then there's a good chance that the average annual return and the IRR are probably a lot more important to you than the cash on cash return. But if you're somebody who may be a little bit older and retired and you're looking to use the income to live every month, then cash on cash return is probably going to be very relevant to you.
Can you explain to us what is the difference between the average annual return and the internal rate of return?
Yes, absolutely. So average annual return is a simpler metric. And what that really does is just taking the total amount of cash flow and the total amount of profit upon sale or refinance and determining what the rate of return is. A simple average, and that's taken by the total amount of money you'll be receiving, dividing it by the length of time you'll be in the investment, and figuring out what that return is. IRR is a much more complex metric and probably more complex than I'll be able to adequately explain on this podcast. But in short, what it really does is it also takes other factors into consideration, one of which is the time value of money. So it's often something that many of us underestimate because we look at it and say, you know what, money's money. And there's some truth to that. But money now has a different value than money in 5 years. And money is always more valuable in the present tense, especially with the way that we keep printing more and more of it. So as that happens, money in the future, even though we may have $1 and $5 and $10 denominations, they won't actually have the same value. So for many of us who are old enough to remember previous generations, a gallon of milk was a lot less in 1950 than it was in 1980. It was a lot less in 1980 than it was in 2000, and it was a lot less in 2000 than it is in 2020. So what happens is even though we have the same dollar or the same $5, the purchasing power is a lot less. And IRR takes that into consideration because it's comparing it to the overall return of the investment, and it's really the best metric to gauge how one asset performs in comparison to another one. So if you wanted to see how your stock investment is performing in comparison to your real estate investment, IRR is probably the metric you want to be focusing on.
Thank you for that explanation. Yeah, that internal rate of return is an important consideration. Fortunately, Excel has a formula for it, and all you have to do is just push a button and it'll pop that right out. But in terms of calculating it is complex. You shared with us pertinent information, but what is the one deciding factor in terms of whether you're going to place an offer or you're not going to place an offer?
So normally we shoot for a minimum cash on cash return of 7%, a minimum average annual return of 15%, and an IRR somewhere close to that as well. So if we can hit metrics that are in that ballpark, then we think it's worth submitting an offer. Now another strategy I would also mention, but I would advocate not to use this starting out. Use it after you've spent some time building good broker relationships and also after you have a good understanding of the market you're investing in and what deals usually sell for. But there are times where I also do submit offers on deals that we're not necessarily going to be competitive on. Now, the key with it is you don't want to submit them low enough where you get the reputation of being a lowball offer type of guy, but you don't want to submit them high enough where you're going to actually be in the running for the deal. And the reason I say this is, again, this goes back to being a relationship business. So one of the things that I do to build relationships is give the broker an extra offer. So keep in mind the broker most times is working for the seller. So their job is to go out there and get offers. So if they have a few extra offers from groups that are out there, it makes them look better as they present to the seller. Instead of saying, okay, we have 15 offers, all of a sudden if 5 groups came in and just gave them additional offers, then you know what, now they have 20 offers and they look that much better when they present to the seller. So the general rule that we figure is we like to submit offers on as many deals as possible, but the ones that we're truly competitive on, we want to see at least those metrics and hopefully hopefully greater.
Good advice. I've often wondered, though, what if you're presenting an offer on a property that you really are not interested in and it turns out to be the high bid?
That would definitely be a problem. What I would say is that's where communication is going to come into play. So what'll happen is many of the deals that a lot of us look at right now have to be determined by market as the asking price. And what that means is that the broker and the seller have no desire to limit the buyer's imagination, and they're willing to let them go wherever their mind thinks pricing can go. Typically in a seller's market, that is more common, and that's where we are now in many markets across the country is a seller's market. Oftentimes the broker will give you what's called pricing guidance. And even though there's no firm asking price, similar to the way that a defendant would tell an attorney oftentimes what their situation is, a seller will often confide in the broker the same way. And they'll say, listen, this is the number we have in mind. This is the number that we're hoping to get for this deal. So with that in mind, the broker will give you a range and say, okay, you'll need to be somewhere around here to win the deal. Now, when they first start marketing the deal or first start putting it out there, the number may be in one spot. But what may happen is after speaking to buyers for 3 or 4 weeks and they're getting ready for a call for offers, the broker may realize that they're going to have some trouble getting the number they initially put out there. That maybe the seller just had an unrealistic number. Maybe the broker made an unrealistic promise that they can't hit. So that's why it's important to be in constant communication with the broker throughout the process and not just the initial time. While there's still a possibility of having that situation occur, it's a lot less likely if you're in regular communication because the broker can usually keep you apprised of anything they're seeing happen, and that way you could adjust the offer amount accordingly.
Charles, you have got some good things for our viewers and listeners. You do a Saturday morning show that actually deals with this process of underwriting, and it is free. But tell our viewers and listeners how it is that they can get involved in this.
Yes, what they can do is they can either reach me by text or email, and they should tell me that they heard me on Dr. Allen's show and that they're interested in joining. So it's every Saturday afternoon, 4 o'clock Eastern, 1 o'clock Pacific. And depending on the session and what we look at, it may range anywhere from 90 minutes on the short side to 3 hours. And what we do is we go through an actual multifamily deal. So we'll take a deal that's on the market, and we also encourage the attendees to submit deals. So it's not just deals that I pick out. And we'll go through one deal each week, do a full underwriting, and I would show you how I normally screen the deal. And then the goal with it is to figure out what are the next steps. 1, does the deal have potential? 2, what are the follow-up items that we have to go back to the broker with? And then 3, we engage in a question and answer period with the attendees to see if they have any questions either on that particular deal or just on the market in general that we can engage and just have a think tank to verbalize those out loud. So they can reach me by text at 347-306-3278 or by email, Charles at 3oaksmgmt, the number 3, OAKS, MGMT, like management.com, and just say that they're interested in joining, and we'll be glad to include them in that.
Sounds like a great opportunity to learn a great deal about that underwriting process, and I think I'll be joining you here soon. So what was the time on that again?
Yes, that's 4 o'clock Eastern, 1 o'clock Pacific.
Okay. Let's go into our last segment of the show. And Charles, share with us one of your most difficult setbacks in life, and how did you come through that time, and what have you learned from that experience? And we're not necessarily talking about your life as an entrepreneur and real estate investor, but we're talking about your life in general.
I'll give 2, one that's real estate related and one that kind of is but isn't. So I'll start with the bigger one, and that's mindset. And it's very cliche that you hear many people say how important mindset is to be successful in real estate, in business, just in life in general. And for me personally, I was doing well enough for myself, making a 6-figure income at a position I had in New York. And when I was 20 years old, with no college degree and figuring out how I was going to pay the bills after my mother became disabled, that sounded pretty good because it took me quite a while to get to that point. When I first started out, I was a bank teller making $8.82 an hour. And I said, okay, I'm not going to be able to pay the rent and pay the light bill and also keep food on the table now that my mother's disabled if I'm only making $8.82 an hour. So lo and behold, I got a different job. It wound up paying almost double that, which wasn't big money, But at that time, it was a big difference. So I said, okay, I'll take it because it was the best option I had. I didn't know that I'd wind up working about 3 times the amount of hours. So when you really broke it down, I was probably making less. But it was what I needed at that time. And I was also fortunate because I learned a lot of skills and developed a lot of character that I didn't have beforehand. So in that regard, it was good. And as my role there increased, I wound up doing more and more things with the company, and my salary increased as well. And eventually I got to the point where I was making a low 6-figure salary. But the thing is, I got to a point where, like many people, perhaps I became complacent. And I thought to myself, when I first started here, my goal was never to stay here indefinitely. It was really to stay for 2 or 3 years and then eventually leave and start my own business. And next thing you knew, I was there for more than a decade. And I started thinking to myself, especially as I went to many real estate meetup events, and people would tell me, Charlie, you give really good advice. And they would take my advice and make money off it. And I would think to myself, boy, I'm glad that I give good advice, but how come everybody's making money off my advice except for me? And what it came down to was that I realized I just didn't have my mindset in the right spot. And I must have gotten conditioned subconsciously to believe that I was good enough to earn a 6-figure salary at a job, but not to go out and do better than that. And around the age of 32, I came to the realization and said, I'm not getting any younger. I've been at the job for 12 years. I wound up staying full time for another 2 years after that. But I said, I have to start taking some action, and I may as well do it now while I'm still young enough and ambitious enough to do this, because time isn't going to do me any favors on this. So I worked on really getting over a lot of self-limiting beliefs and a lot of beliefs that I can give this advice and give people the ability to make money, but not do it myself. And that's something I had to really work on. I had to think to myself every day and just recondition my thinking and say, I can do this. I do these types of deals in my full-time job anyway. Why can't I do them on my own? With the one caveat being that I knew I didn't have the budget for it, whereas the gentleman I worked with did have the budget to do commercial real estate. So when I learned about syndication, I said, I can do this. I can use the skill set I've developed. I can use everything I've learned. And now with syndication, I can also use other people's money so I can tap into the best of both worlds. So for anybody out there, one thing I would tell you that's really important is keeping your head in the right direction. Sometimes that's easier said than done. There's a lot of negativity out there in the real world. And there's a lot of things that for lack of a better term, can kick us in the uprights. So we need to find a way to stay focused and to really control what comes into our minds. We need to control what we read. We need to control what we listen to. We need to control who we associate with, because all of those things have an impact on our mindset and our ability to perform. So if you want to position yourself for maximum success and maximum efficiency, you need to protect at all times what goes in there. That is far and away the single most important thing. And a second thing I tell you, a much quicker example on a real estate sense, about 2 months ago, we closed our third multifamily syndication deal. And generally, I tend to like stress. For better or worse, I probably do my best work with it. But I will say, even though I generally do like stress in my professional life, this one may have got a little more stressful than I had anticipated. And we were under contract, and the contract had us scheduled to close by January 28th. And as we were about a week and a half away, we realized we were going to need a few extra days. Not a substantial amount of time, but a few extra days. So we reached out to the broker and we said, listen, why don't you tell the seller, see what he wants. Let's see if we can negotiate a short extension and get past it. What happened is that initially the seller was receptive to that. And he said, okay, I'll give you an extension for another $50,000 deposit. So after a few days, and this is a lesson for anybody out there, sometimes you have to move fast because minds and opinions change. We did not accept the offer as quickly as we should have, and that would come back to bite us. And then the seller decided that he was no longer in favor of the extension afterward. And I said, that's going to be a problem because we're not going to be able to close on time. So we had about $250,000 that was non-refundable at that point in the deal. And we said, this is going to be a very painful lesson if we wind up losing on this one. So what wound up happening is the day before the contract was set to expire on the 28th. The seller was here in Charlotte, which is also where I am. And I said, I haven't had any success being able to get through to him. I was trying to reach him directly at this point because I said, you know what, let me see if I can pull a rabbit out of a hat and make the deal work. Because at this point, we're 24 hours away from being in default. And even though we would still have the intent of closing and it'd only be a few extra days, technically, he doesn't have to close. So I went to his office and I said, let me take a shot and see if I can just get him in person and maybe sit down with him and reason, beg, plead, whatever it took. So I went to the office, and unfortunately, the secretary informed me that he was at an appointment. So I said, okay, I struck out there. So went back to my office. And when I got there, I said, okay, let me send an email. I sent it directly to him and I copied the broker on it. And I said, let's try one last ditch effort and just see if I can do something to engage him and get his attention at this point. So I offered him 5 different options. We offered him an extension fee. We offered him, additional hard money that would just be applied to the purchase price. We offered him part of our ownership in the GP to actually be a partner in the deal with us and stay involved. We offered him, because we knew his staff and his employees were very important to him. So we offered him, a compensation package for them. So the good news is it got the seller's attention. And we did get a reply to that email, so that was effective. I was expecting he would choose maybe 1 or 2 of the options, but he chose part of all 5.
Keep things complicated.
And I said, that was more than I was expecting. I wasn't really looking to give all 5. I was hoping it would be 1 or 2. So I said, okay, at least we engaged him. So we had to go back with a response. I reviewed it with all of my partners, and we said, okay, let's give him a little more non-refundable money on the purchase price. We'll also give him an extension fee on top of that. That's not going to be applied to the purchase price. And we gave him part of our percentage of the GP in the deal. So we said, okay, it ended up getting the deal done. They were probably the most strenuous 48 hours of my professional life because I was really thinking, boy, this is going to be a mess. And even on the day of the 28th, we had our attorneys working out the amendment. And around 6 o'clock at night, I had signed it and sent it back. And I didn't see anything come through because I signed it first. So I was thinking to myself, is he going to sign it or not sign it? And by the time I went to bed around midnight that night, there was nothing in my inbox. I said, oh, that's not good. Thankfully, I was happy the next morning around 8 o'clock. It came through and I said, okay, well, at least he signed it. It was strenuous. So the lesson out there for anybody is, 1, do the best to adhere to your contract deadlines. And 2, sometimes if you have a good offer, even if it seems like it may not be great, take it. In retrospect, I wish that we had jumped on the $50,000 extension he had given us a week earlier. And I said, in retrospect, that was a lot cheaper than what we wound up doing and a lot less stress. Sometimes there is something to be said for moving fast.
Yes, but those are big decisions. It's sometimes hard to move on them fast. But good advice, and thank you for sharing that experience. Charles, imagine that you have come to the end of your life, and as you lay on your deathbed, what will you look back on with your greatest joy and a sense of fulfillment?
Yeah, it's a great question. I think it's always one that's tough to answer and probably one that evolves as we go through life because we may be in different phases. So for me personally, I'd like to be remembered as somebody that helped people achieve their goals and dreams, also achieving my own. And I'd also like to be somebody that was generous and gave the people, animals, and different beings on the earth and just did the best they could to advance life for as many people as possible.
Excellent goals, Charles. And once again, it has been a true pleasure.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Seed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our effort to make the world a better place, Seed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Seed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at seedtalker.com.